Welcome to Private Capital Perspectives, a podcast from the Lineup Media Company. On this podcast, I sit down with operators, allocators, and investors to break down their strategies and learn more about how they're deploying capital across private markets today. My name is John Pugh. I'm a developer, operator, and real asset investor. Each episode brings candid conversations from the front lines. No filler, just insights to help you make better decisions and stay ahead of the market.
At Pew Capital Partners, we work with family offices and private investors to create lasting value in real estate. Our mission is simple: the right projects, the right partners, and the execution to make them succeed. With 60-plus years of combined experience and over $1 billion in multifamily, industrial, retail, and mixed-use projects, our team knows what it takes to deliver. From planning to completion, we lead with discipline, transparency, and creativity our partners trust. Our approach rests on three principles: protect capital, invest with discipline, and invest alongside our partners. We pursue opportunities with strong fundamentals and real growth potential, generating income today while building legacy for tomorrow. To learn more, visit pewcapitalpartners.com, where excellence, alignment, and legacy guide everything we do.
Today on Private Capital Perspectives, I'm joined by Jensen, a real estate operations and asset management leader with more than 18 years of experience across multifamily, hospitality, and institutional real estate. Anna's work focuses on the part of the business that really matters once a deal is closed. It's operations, asset management, reporting, leadership, and focusing on investor outcomes. This is an important conversation because in today's market, execution matters more than ever. Capital markets are tighter, business plans are harder to execute, and strong operations can really make the difference between a deal that performs and one that doesn't. So today we'll talk about what great asset management looks like, how owners and investors should evaluate performance, and what separates average operators from excellent ones. Anna, welcome to the show.
Thank you. Thanks for the introduction. Happy to be here.
Yeah, great to have you. So let's just start with your background a little bit. How did you end up in asset management? What was the path that you took to get where you are today?
Yeah, thank you. You know, that's a loaded question, and it's probably not traditional, right? I didn't go to school for real estate, so we'll back up a few decades and explain how I kind of fell into real estate and the history there. So, you know, I went to college for psychology, wanting to be a forensic psychologist. The school that I went to didn't have that particularly, so I studied psychology with a minor in forensics. You know, I did well. I had an internship with the state of Colorado. That internship led into a researcher job, and I was really studying our tax revenue in our institutions, our non-private prison systems, on where tax money was being fed and led into for educational programs that were being offered versus what the inmates they needed. So that was through my 20s, but I was pretty reckless in my 20s and a little bit lost on what I wanted to do and if I liked it and if I didn't. And by the time I was 26, I was pregnant, and I knew I was going to be a single mom at that time. I remember going and complaining to my apartment manager at that time of I didn't want to go back to doing what I was doing before. I wanted to stay closer to home. I was a single mom. I chose that journey. I really didn't know what was in store for me at that time. And so 2008 hit, and I was a leasing consultant there in the apartment community I was living in. A completely new career path, new mother, and during the great financial crisis, worked for a really large organization at that time who had a great footprint across the U.S. And of course, during the great financial crisis, we had some hardships, and that company did fall under receivership. But, you know, I worked through it. I stayed boots on the ground. I had a home there. I had my baby in my arm, and, you know, I was still representing as a steward as I should for the company all the way to the end. And, you know, that was a pretty good learning experience on what happens sometimes or could happen when things don't go our way or a real estate cycle shifts, and learning the capital structure at that time and why that comes, you know, there was class action lawsuits. Of course, that doesn't happen and close overnight. Those are typically 3-year processes, and lender-controlled environments and what happens when the lender takes control and doesn't want to pay the bills but only wants to collect the money. Lots of stuff and lessons learned, and that's all it took for me to really be hooked in the industry and continue. It absolutely didn't scare me with what I enjoy challenges. I enjoy creating. I enjoy setting things up and solving problems and identifying and finding solutions for things. So after that, I worked my way through property management, worked with Dean Widener in Colorado, the Griffiths Blessing, that's Buck Blessing and Ian Griffiths, who ended up separating and starting their own groups on both sides, and then had a very strong learning cycle with Greystar for 7 years and growing and learning the strategies of all of the large players that I worked for, and the market has really built me into who I am today. Their strategies, one isn't better than the other, as they're all very, very successful. It's just their vision and what they did with capital and leverage was different. And so I blend that in who I am today. And at this time, I'm not an owner. However, it is coming. Probably the right time is going to be in the next 12 to 18 months and picking up some REOs. But what I do now, and I missed a little spot there of how I jumped into the private equity space from institutional big players and launching Serene is I had an opportunity to really help a private equity group build out asset management and vertically integrate property management. And at that time, I met some other partners at that time who were buying, and we developed Scout Rock Capital in the midst of also growing Serene. And so that's kind of my experience through institutional world to private equity. We absolutely had asset management within Greystar. He's third party as well as owner operated, and I was able to work on both sides and be on his legacy build development for his prize brand of the Onyx portfolio, and really building that out on that team with underneath Bob Faith's company was just profound in my learning experience with asset management as well. So Serene now focuses on providing that operational excellence and being that partner in execution and building back what maybe has been lost, and really helping to stabilize assets and where they should be with the operational excellence that these assets deserve.
So that's your current company, Serene Multifamily. So
That's
tell
right.
us, how did that journey begin? What has been the arc of that business that you founded?
Well, the journey with Serene was really started when I needed an LLC, right? When I started to work for myself instead of a W-2. And so, I created a couple different ones before I really thought, well, I really need to think about my brand here, and where I'm going. So it started off almost as an education. Serene was an education area. So I started educating Asset Management 101, pushing podcasts, pushing classes, holding classes,
Really?
small ones in Colorado. It
Yeah.
didn't go my way. We had to, there's a lot of challenges that happened as far as, doing prerequisites, making sure that people were coming in actually had somewhat of a foundation, not just somebody off the street. And then all of a sudden you're talking about what is property management, and you don't get into what asset management actually is. So there's been a lot of ups and downs at the launch of Serene and what it was, but it grew from an educational platform to an advisory platform where I was just working by the hour, and paying people would pay me for my time and expertise, right? And during that time, I also had W-2s. That was just a small little side thing that was launching. Now it's grown into a great foundation of a company over the last few years. It really focuses on three main avenues of what we do underneath Serene, and is continuing to grow.
And so what are those three avenues again, if you don't mind?
So I really have three different clients that I speak to, and those are going to be fund managers are going to be my typical client. Fund managers that have a large percentage of control and the assets that they invest in with the sponsor. And so these fund managers typically don't have a lot of the active asset management experience to step in and want to take more of operational arm, if you will, and understanding what's happening with the asset, or perhaps stepping in and taking a bit of control back because the assets aren't executing the way that they should. And so they really need to bring somebody in that can speak that language and delicately work with the sponsorship group. The external partners bring confidence back to investors and lenders and move the dial, right? So that's going to be my biggest client there. Of course, I work with sponsor groups that need a little bit more attention to asset management, or they need asset management. Perhaps they have somebody, there's a relationship that fell apart with where we are in the real estate cycle and they're missing some pieces, or they just need a little extra leadership in their department because they launched during an upcycle, right? Where that operational foundation isn't necessarily seen as much as it is now. And the third group of client that I work with is lenders. So lenders will reach out, especially now, if they need help with taking over an asset and they need it stabilized. And those are typically contract driven, and they need some active player to really be gritty and boots on the ground and stabilize this asset that they've taken back. Secondly, partnered with that, sometimes they'll reach out just for that sophistication piece of, hey, we are working with a sponsor who doesn't necessarily have the resume we want to see right now because there's so much attention to that experience for asset management and operations. Can they use you for advisory services for us to have more confidence in closing this deal with them? And so I'll sign on with that as well.
Fantastic. Those are some great places to be, especially in the market today. You recently wrote about multifamily is not broken, but recalibrating. Maybe you can speak a little bit to that because it very much ties in with what you were, I think, just saying.
Yes, and I felt that was such a need to push out there and where we are, because there's so much negativity, right, on where we are. We've taken huge decreases, vacancies at an all-time low of 7% nationally. And so these headlines just keep on being pushed through the market. We are where we should be to recover from an artificial cycle that was driven by COVID. And real estate cycles typically take a while, right? But what we saw with COVID, we saw a very fast cycle over 3 years from start to finish, right? And so it was artificially driven. And what drives real estate cycles is supply and demand. And so when you mess with that, and that's exactly what COVID did, we had a mess on our hands, right? And so we're on the other side of being in the middle, but we're on the upward trend of where we should be to recoup, to be back to a regular real estate cycle. And not only that, but there's huge wins to pull out of this and where we are with rent growth. So if we look at the normal trends from where we were before COVID, from 2021, and where we are with rents, even though we've taken huge decreases right now and we have some supply that we're absorbing and all this, we're still 20% above where we would have probably been on the delta of trends that we were headed in before the COVID hit. So we really need to focus on that, not only focus, but communicate those wins to our investor groups, to our lenders, just to build that confidence and positivity that we're going in the right direction. Real estate and multifamily is absolutely not broken, and it's doing exactly what it should be doing to get to that balance point of a normal real estate cycle, and that is called recalibration. And another thing to focus on is nationally, we finally hit a 7% vacancy on a national level, right? That doesn't mean every region is there. It just means average on a national level, we hit a 7% vacancy. That is huge, right? That's the biggest that we've seen since the early 2000s, right? But what that shows us is we've hit our bottom, right? We finally have hit our bottom on absorption. And now we're on the upward swing of what's going to happen over the next couple of years. There's some groups that say, oh, this recalibration or this balance is gonna end in 2026. Real estate takes a while. We're not dealing with quarter over quarter changes. We're dealing with leases, we're dealing with construction timelines, we're dealing with feasibility studies on what works and what doesn't. We really need to think about the supply, right? When is that going to be fed back into the market? And so I really think we're going to see some great huge rent increases year over year, up to 3%, 5% by 2028. At that time, we're going to see more development hit the market. You need to keep a very close eye on affordability right now and what that means in the market as far as our average wage increases that are happening and what that means for market rent. But those are just probably a whole nother podcast here. But we have some really positive things that are happening in the market right now for multifamily. And with excellent operations, excellent strategy, excellent asset management, we are going to see a turnaround, and that's what we need to focus on.
Yeah. Well, I think you just hit on a lot of important points. I think one of them definitely strongly agree with is that the message sometimes gets mixed up, right? In terms of, because of what happened in 2021, 2022, there was this massive reset of expectations to an unrealistic level that everything has been skewed in terms of that reference point. And if you really just look back to pre-COVID and look at where rents are going and occupancy, there's definitely a lot of positive things to be said, and most people aren't really telling that story. They're focusing on the fact that there's a massive amount of oversupply. They're focusing on the rents situation. But if you think of this cyclically as opposed to in a short-term 2-year, 3-year cycle, it's not a 2-year cycle like you just said. It's a very long business cycle that you have to really understand kind of where you are in, and it's very easy to lose sight of. I think one of the things that I'm curious to hear your opinion on, given your experience with basically turning around some problem properties, but also seeing some of these properties that some of the different banks are taking back. Typically, when you see a property that's in trouble, where is usually is there a specific thing you can point to? Are they all extremely kind of unique situations, or are there some type of trends that you typically see? They're not pushing rents hard enough. They're not keeping, the residents satisfied. Like what are some of the key points there?
I mean, that's a very loaded question, and it's not one
Intentionally
answer.
so.
Sure. There's not a clear answer for every asset or asset type, right?
Yeah.
And the variables go all the way down to how it was structured and who were the players on site, all the way down to property managers, right? But at the end of the day, it's tank. It's 30% occupied. It's 50% occupied. Operators have given up. People have been displaced. PR is crashed through the ground. I mean, by the time the lenders take it over, it is the worst of the worst, right? And there's been really ugly relationships along the way, intention along the way that, give that attention to detail. They didn't have an Anna on site that had a baby in her arm that was there to the end.
Yeah.
Like I did during that time, it's brutal, right? So by the time the lenders get it, it's a very distressed asset that needs a lot of attention to detail, and then you just get back to the basics, right? And you are working the dream of you're fixing it, right? And you're creating it as an asset manager. You're going in there, you're building it. You have 12 months. Right? Or less, hopefully, but you're looking at a 12-month turnaround, and it's basically a lease up. And it's a lease up on a vintage asset, not a brand new product. And so you need to have that high velocity attention to detail and be strategically positioned in that micro environment to lead it, right? To turn and to also have the right PR player, anything that you can do within what the lender's able to give to get it to where it needs to be. So, I don't walk in and have, a huge bucket of gifts of getting this property to a stabilized level. I have inflection points that I look at, and I have equity patience that I don't have, right? That I typically would if we're on a regular structure, or an acquisition or a new build, right? We just have that high velocity push to stabilize.
Yeah, so that was a loaded question, and I will add to the reason that I asked the question is we've been looking at some properties that are brand new construction, pre-stabilized properties. They're having trouble stabilizing, and it's extremely clear from someone who's a developer that The whole reason they can't stabilize is because they can't drop rents because they won't hit their debt service coverage ratio, and as a result, they're kind of stuck. And they're offering, a lot of these groups are offering incentives, they're offering a couple of months free rent, etc. But effectively, they can't allow the property manager to do their job because they're handcuffing them to these higher rents that aren't necessarily the market rents because they haven't been allowed to reset. Have you seen that at all in the market? I've seen a bit of that in some areas around here.
Yeah, it's happening all over the place, and
Is it?
there's kind of a few folds here that I'm going to go back to with what you just said. Is we have an absorption problem because of the supply that's hit the market. I mean, that's a story that's been told for a long time. It's there, it is
Sure.
changing, but it's still currently there. And then we have hit our back door in lease ups, right? And hitting our back door means that we have people expiring at the same time. So we're not getting as much people in the door as fast as we are getting people out the door. So that's problem one. But then let's go back to your statement on DSCR and not hitting DSCR and being constrained to rent. So there is a strategy to still hold value and still hit DSCR, and that is being able to manipulate that base rent to get occupancy in the door immediately, because you're losing more money and having a lower DSCR sitting on all that vacancy versus taking a hit on 15 units, 10 units, depending on how large your asset is, that moves the dial 1%. So if you choose a select number, right, of active units that hit the market, be strategic on floor plan exposure. So you are your own rent revenue manager, right? You don't need a yield star, you don't need all this. And you're manipulating your prices above what the micro demand is calling for on those set units. You can quickly increase revenue, increase DSCR, increase occupancy, and then you keep your majority base rent the same, and your revenue and value for that asset has dropped, and it hasn't dropped significantly to move the dial, if you will, because you're working on a select few. So again, there's strategy for everything that we do in asset management, and it needs to happen, right? And that's not the answer for every single lease up. That's not the asset for every single region. You have to look at your equity patience, your lender thresholds, what you're allowed to do, your operating agreements, your constriction, your restrictions that you have on your lender thresholds. You know, all of that tells a story, and that's what asset management is, right? And sometimes we actually have to get deep into the weeds on pricing and pushing our operations forward, and being able to get deep into the weeds as well as stay over here on strategy and vision and growth is super uber important.
Yeah, that was kind of, I think you partially answered it, maybe you've answered it, but when you're advising funds and they're looking at because they don't have the asset management experience that you have in-house, are there key kind of pieces that you typically look at or provide kind of feedback on? One of them you said is clearly the operating agreement's paramount, but I'm kind of curious if other pieces other than the operating agreement that you really kind of dig into?
Everything. So I look at all of the tranches, all of the structures on capital. I look at pref, expectations, what's given, what's still there. I look at the splits, you know, what investor gets and promote for investors. It all tells a story. But when I'm working with fund managers, the operating agreement is super important because, you know, they have to have controlling rights. You know, sometimes everybody goes up to bid and it's a voting, you know, are we going to let Anna in to help this asset? Are we all going to play nice in the sandbox? You know, those types of conversations happen, and they need to happen, right? And so at the same time, funds need to become more active right now with what's happening in the market. They absolutely need to understand asset management, the numbers that are coming back to them. And I say that because with the break of AI that's happening right now, there's fragments that are happening. There's not the right governance that is happening all the way down to our property management that's using AI, and then it gets fed to the sponsor groups that's also compounded AI softwares, and there's errors there that aren't being caught.
Oh, really? Mm.
Absolutely. And then it gets to our fund managers that are using AI and software. So it's 3 times compounded, and when there's an error or a trend that happened 90 days ago, that's also compounding on incorrect errors. And there's nothing more frustrating than incorrect numbers, right? So to be able to understand governance on AI, and AI is fantastic. It's fabulous. It's multiple, it's 3Xing all of us in major ways. It's moving faster than humans can keep up. It's really exciting. But at the same time, we have to have that governance, and we have to have that eye of knowing what doesn't look right and what looks right, and be able to identify those fragments and fix it before it's compounding, right? And the only way to do that is through experience and asset management. And
so are you referring to reporting, like financial numbers, or are you referring more to legal documents, or all of the above?
oh, both. I mean, we have found errors in operating agreements, all the way down to waterfall structures. I mean, it's just
That were created
happens.
by AI, by somebody just used your AI to create them and they sent them
Well,
out? Is that,
I don't have the answer to that, but the fact is there's errors, and a lot of it is created by AI and plugging it in and saying, "Hey, do
yeah,
this for
yeah.
us," right?
Interesting. Yeah.
And you can fix it, right? We can fix some of these things, but it takes a lot of work, and these errors
Sure.
shouldn't be in there. There's huge risk and liability there. And the fact is humans aren't perfect. We don't know it all. AI isn't perfect, even though
Sure.
some people will say it is, but it's not.
Yeah.
There's errors. Sometimes it's misinformation. It's not working correctly. But together we can be near perfect, but it takes the right governance.
Oh, yeah, for sure. Yeah, I was asking because I was negotiating a contract 6 months ago, and this gentleman continued to respond to us with AI generated information as we were trying to negotiate the contract, and it was extremely frustrating. Everything was clearly straight out of ChatGPT in terms of his answers to us, and it was kind of incredible. I had not been involved in a contract negotiation that was it felt very impersonal, but it also felt like there was a huge disconnect, and we ended up, but I'm not surprised to hear that it's wreaking havoc a bit. But you're right. If you don't have the right experience, you don't have the right people looking at the information, lots of things can be missed. And as you said earlier, it is so much about the details. Like all of our business is the details, and if you don't have those buttoned down, there's going to be a variety of different potential conflicts, that pop up. Are there any trends in the industry that maybe it's AI, maybe it's some other things that you're particularly excited about, where you think there's a lot of value to be added in the asset management process that you're seeing today?
Yeah, I mean, I think there's a lot of things to be excited about. We already chatted about some of them in regards to the industry as a whole and real estate cycles. And I do think there's some really great software that's going to hit the market for asset management. I am excited for that. I don't think there's good asset management software out there to help us do what we do as asset managers, and that is because we were in the age. We saw 10 years of a balanced cycle, and then we were in a huge up cycle right when all this software became easy to make and good to make. And so there really wasn't a need until now to have the analytics that we need for what we do on asset management. So I think it's really exciting for more software to hit that is able to be used outside of ecosystems that are currently in place. And don't get me wrong, RealPage, I love RealPage. I wish I could use it every single day. But let's be honest, it's pricey, it's the bells and the whistles, and you have to use this ecosystem on all of the below tiers for it to work correctly for asset management, and that's just not reality in what I do. I work on 15 different softwares, each sponsor has their own structure, so being able to have a platform. And it's funny because I've done many things in my life, and it's funny that I'm messing around with coding now through Claude. I never would have thought that I'd be here, but I'm very frustrated with all these tokens and cutting me off. I mean, we can work.
Me too.
Once we start going as visionaries and creators, we could be working on something for 12 hours straight sometimes, and you can't cut me off on hour 2 and say, come back tomorrow. So I think there's more exciting things coming in the future in regards to software for what we do for the right people. And then bringing the most important thing back to the market, and that is operations and the importance of operations and being the main thing and the glue that makes the business plan work. There were so many years where it was just raise money, close deals, raise money, close deals. And I watched it actually go by the wayside and just trying to hold on to operations in the groups that I led. Just a lot of frustrating times, and now it's so exciting to be here and be a great leader in what operations is and help build the next generation of financial stewards for what we are in asset management and operations, all the way down to property management, because our property management teams are executing our strategy, right? We are the leaders. They execute per our business plan, and we are the main leader there. So really bringing that importance back to the industry is the most exciting thing for me.
Fantastic. Yeah, I couldn't agree more. So, Anna, just wrapping up, what's the best way for people to reach out to you, connect with you, follow you on social media?
So LinkedIn is the best way to reach out to me on social media. It's just Anna Jensen. You can also research Serene, that's Serene Multifamily, and that's serenemultifamily.com. You can do contact me right from my contact us page that goes directly to, or you can email me at anna@serenemultifamily.com. I am quick and enjoy dialogue and being creative and getting things to where they need to be. And I really hope to find the right groups to really GP and take on some great owner-operated deals in the future.
Fantastic. Thanks again for joining us today, Anna. Have a great one.
Thanks, Tom. You too.